is. There we go. Okay. So, how many of you guys have a pension or know what a pension is? How they even originated?
I don't know how they originated, but I know what they are.
Well, pensions started out because companies, after you'd been with a company long enough, felt kind of a family obligation to a lot of employees because they'd been there so long. You know, they knew everybody who worked for them. They knew their kids. Their kids grew up with them. They knew everything about them. You know, they were usually the town business um, because I mean, when you have um, a company, and in a lot of cases, it's just a couple of big companies in a small town. That's even a possibility. When they used to call them coal mining towns, that's what supported the entire town. That coal mine or the salt mine or whatever it was. Well, they considered them families. So what happened is they would actually feel an obligation to take care of their employees after they'd been there for a long enough period of time. So they would do so by actually starting a pension plan. So they would start contributing money into a fund for their employees to build up over time. And this was great. If you were a long-term employee, you would get a pension. I mean, how many of you guys have somebody or know somebody on a pension?
Yeah.
My dad's on a pension.
It's very common.
It happens all the time. Nowadays, it's a pretty rare thing for it to occur. Sometimes with union employees and that sort of thing, there are pensions. But with a lot of the normal companies that are not unionized or something like that, there are no pensions anymore. They've been replaced with the 401ks. Pretty much that's now your retirement method. So the pensions, they are a great way to save up money and then get money back. Now, do you guys know what an annuity is?
Similar?
An annuity is entirely different.
I had to take out an IRA because I've only ever worked one place that had any of these things.
Okay. Well, no, an annuity isn't based on your employer. An annuity is something you can get. Okay. It's sold by an insurance company. And what it is an annuity is a different way of saving money. It uses post-tax dollars. So you can guess that it's typically tax deferred or tax-free, tax exempt, because it's usually using post-tax dollars. And as a matter of fact, for most people, they don't realize that even the former treasurer of the Fed said this is the only way to save money now. Because annuities, what they allow is you to put money into an account on a regular basis using post-tax dollars. And then once you reach a certain age, it starts giving you money back, just like a pension. An annuity is basically an individual's form of a pension. You create your own pension plan. All right. So let's start taking a look at it. So what ends up happening is a pension, go back here, is basically a qualified employee plan. Okay, so let's go forward here. That's what this last kind of thing here is, a qualified employee plan. So what happens is you have an amount that you agree to put in each month, or at whatever rate you can contribute to them to an annuity as a single premium, like a one-time, like let's say you have a settlement from a lawsuit or something of that nature, and you want to use it for your retirement. Okay, you can make a single one-time large premium payment, and if you get, let's say, like I said, a settlement from a lawsuit, an inheritance, something like that, and you want to have it be your retirement fund. A lot of times what will happen is, let's say you're a husband and wife, and the husband passes away or the wife passes away, and there is a large life insurance policy that pays out the death benefit. And what ends up happening is they want to make sure that that death benefit is used to help provide money for the survivor over a long period of time. Okay. So what happens is they use the funds from that death benefit to pay for a single large payment, a single premium life annuity. So it all goes into an annuity, and then what happens is the annuity, instead of it paying out like a life insurance policy where it pays out a single payment, it pays out over X number of years. So it'll pay out over a 10-year annuity, a 20-year annuity, something like that. So for 20 years straight, it'll pay you X amount of dollars. Okay. You pay into it for 25, 35 years. It will then pay you back over time. Now they're going to use that annuity during the intervening years as a money building ability. You know, that's how they increase the value of it. And then it pays you back once you start collecting from it. Okay. So when a pension comes out, it gets reported on a 1099-R, and it will show you how much was distributed to you in that particular year, be it $12,000, $20,000, $50,000, and that is a set amount. Okay. So there's also a worksheet which shows exactly how you would calculate how much is taxable. Now, in most cases, annuities are not taxable. Okay. But there are certain cases, depending on if you have to pull it out early or what the situation is, and you have to know each different annuity, and you have to know which one's a qualified plan, which one's a non-qualified plan. Okay. So if the taxpayer does not know the taxable amount, because what's going to happen is this is the taxable amount right here, listed here in the annuity. Let me show you this here. Okay. Here's the taxable amount, and it is listed on box 2A of the 1099-R, and this is the amount that shows up typically from a pension, but most annuities are not really taxable. They're usually tax exempt. All right. So if they do not know the taxable amount, you use the simplified method to calculate the amount. You can use the simplified method worksheet if all of these apply. The annuity starting date is after November 18th, 1996, and they received either the pension or an annuity distribution from a qualified employee plan or a tax sheltered annuity plan, and either under age 75 on the annuity start date or entitled to less than 5 years of guaranteed payments. So in other words, remember I said an annuity is for X number of years. Okay, it's for a 5-year annuity, a 10-year annuity, a 20-year annuity, however many years they're going to pay out for. So if it's a less than 5-year of guaranteed payments, that would qualify for the simplified version. Okay, so let's get into it in a little more detail. This is the publication. It is the publication 939, the general rule for pensions and annuities. These are for the non-qualified plans. Okay, you do not use the simplified method for annuities starting before November 19th, 1996, and taxpayers who were at least 75 when the annuity started. Okay, these are the stipulations. There is the simplified and the non-simplified. Use the general, simplified, and the general rule. Okay, so you follow the guidelines as to which rule you use. If it is for the simplified one, it has to be for an annuity starting after November 18th, 1996. If it was started before November 19th, 96, you have to use the general rule. All right, so pensions and annuity, and then there's a disability distribution reporting. So if there was something that caused the annuity to be released early, in other words, a disability. If you developed a disability, there is a clause in it that says you can use it like a life insurance policy or like a healthcare benefit. So you can actually start pulling money out against it. Now this thing works. Most annuities and life insurance policies now work kind of like a Swiss Army knife. All right. They're a single retirement plan that you put into and can be used in multiple ways that you take them out. Okay. Do you understand what I'm saying by that? You understand, Pam? It kind of looks like you put it in one way and you can pull it out multiple ways.
Okay.
Okay. So what it means is they're not like they used to be, where a life insurance policy, you put in money, pretty much when you died, you got it out. Okay. It was pretty simple. That's the way a life insurance policy used to work. You put money in, when you died, you got money out. Annuities and life insurance policies nowadays don't work that way anymore. Okay. They work like a Swiss Army knife. You put money in, and you can put money in various ways. It can be a large premium. It can be single payments over time, things like that. And how you get them out now has a whole bunch of different ways you can get them out. All right. You can get them out for disabilities. You can get them out for long-term care. You can get them out for a death benefit. You can get them out for a regular payment over time. So it's like a retirement plan.
Mm-hmm.
Okay. So like I said, they work more like a Swiss Army knife now. They don't work like a regular, like they used to. All right. So you can put money in various ways, and you can pull it out in various ways. They're not considered just like they used to be, where it's one way in and one way out. All right. So it gets reported to you based upon the distribution type. Now, the reason I say this is because there are a whole bunch of different ways into it. Well, like I said, there are a whole bunch of ways out. Long-term care, short-term disability, a death, a permanent disability, a actual retirement. You can take a loan against it. You can actually take a non-payback loan against it. In other words, one based on it being your own finances, you can actually take a loan against it that you basically never pay back. Okay. So distributions before the retirement age and distributions after the retirement age. This is the primary difference between the distributions as to if they're taxable or non-taxable. Okay. If it's before the retirement age, a lot of them are considered earned income. Okay. That is the difference. If you take it out before the retirement age, it is considered earned income. If it is a distribution after the regular retirement age, it's considered retirement income, and it changes all of the different values as to what it's being taxed on. All right. So if a taxpayer receives a retirement plan distribution as a result of a disability, however, a distribution code of 3 is put into this box. That makes it treated just like it was a retirement age situation, because it's a disability then. All right. So if it is previous to the retirement age, any idea where it goes on the 1040?
It's reported as wages.
It's reported as wages. So it actually goes on the 1040 on line 7. Once they reach the minimum retirement age, then it goes onto the form and gets calculated for its retirement value. Okay? After you reach the minimum retirement age, it's then taxed as a retirement plan, or as an annuity. All right, so these are the statement of an annuity paid. These are for specifically an annuity. They are a little bit different. They're a special reporting instrument to show that they are how an annuity is paid out. In other words, pretty much okay, what's with the bird?
That's my clock.
Okay, I was like,
It's 3 o'clock.
that's your
It-
clock. I
It
got
was
it.
my mom's clock, and when she passed away, I got it.
My granny had
Okay.
a clock like that.
I'm
All
afraid
right.
to take it down, you know.
Yeah, don't. I remember I used to, my grandparents used to have one of those too. It was an actual cuckoo clock. The bird came out and,
Well, this is a different bird for every hour.
That's what my granny had too.
okay. Okay, so there are different kinds of 1099-Rs, okay? There is a CSA. Now, this is the statement of annuity paid. The CSF is a statement of a survivor annuity paid. In other words, a husband or wife was paid. And then there is a special one for annuities or pensions by the Railroad Retirement Board. As you guys know, there's a lot of things, you know, the Amtrak rule. Anybody know the Amtrak rule? God, I hope so.
Amtrak rule?
Yeah.
Nope.
I don't know. Like railroad retirement? Is that what you're talking
Yeah,
about?
pretty much.
Oh,
Oh, okay.
The Amtrak, where conductors are spend time a lot across state lines. Maybe it
Yeah.
just happens in Portland a whole lot more. Okay, because we go across the state line all the time.
Mm-hmm.
So we have special considerations for a lot of our people, like the train conductors and that sort of thing, because they go across the state lines between states that either do pay taxes or don't pay taxes, especially between like Oregon and Washington, as you can imagine. Oregon likes getting its taxes. What can I say? So we have certain Amtrak laws going across state between states like that.
Does it have to be Amtrak? Can it be?
No, it can be any
Pacific?
railroad. We just call it the Amtrak one because
Okay,
all the
so it's kind
railroad
of like
ones.
Xerox and copying. Okay.
Uh-huh. Exactly.
That's why I'd never heard of it.
Yeah. No, it was originally, I think, put in place by, it was originally petitioned, I think, by Amtrak is why it's called that. But yes, it's based on the railroad. Well, as you know, there are lots of rules, especially for the railroads and things like that, and pilots. Well, they have a lot of annuities as well, annuities and pensions put in place by the Railroad Retirement Board and by the the railroad unions. So there's a special one specifically for their annuities and pensions. So there's a 1099-R specifically for the Railroad Retirement Board. It is an RRB 1099-R. And it actually just has a different layout. There isn't anything major about it. It's just a different layout for the 1099-R, basically. Okay. So let's go over this. So this is an annuity paid out. Okay. It's just showing that the employee's contributions were $748. It is a non-disability distribution. Okay. The total employee contribution was $16,588, and the gross distribution that they got out were $13,886. Okay, the employee put in $700. The employee contribution was for its Roth contribution or insurance premium was $748. The total employee contributions were $16,588. It got out $13,886. Now, of this, the total taxable income because if you take that $748 off, because that was a Roth contribution or insurance premium, so it wasn't considered taxable, the taxable income that it has was $13,084. Okay. Federal tax withheld, 446. There were no state income withheld. Okay. It's pretty simple. Okay. This is what a payout looks like. It's not too difficult. When you report it, there's box 1. The taxable income is box 2A. All right. Are we clear on this one?
Yep.
I mean, it's really not, it's not a hard thing. Okay. Now, what would this basically be? Because this is a CSA 1099-R.
It's an annuity.
Right, but it would be a payout. It would be a regular payout.
Yeah.
Okay, this is a statement of an annuity paid. If it was a CSF, it's a survivor one.
Right.
Okay, so this is what happens is the amount shown in box 9B means that the former employee has a basis in the plan. Okay, so the former employee has a basis in the plan and some of their distribution may not be taxable. Okay, but that's something that would have to come off of the worksheet. Okay, and what you do to calculate this is once you have this amount, they have a basis, and the correct taxable amount is actually here in 2B. They have a contribution that they've contributed. You see here in not box 9B.
Mm-hmm.
So over here in 2A is the correct taxable amount. They're only taxed on 13,000. Okay. All right. So now this one is the survivorship one. It reports civil service annuities paid to a survivor beneficiary. Okay. And the distribution code 4 is always used on this type of 1099-R. Okay. It's just the way it's set up. They have their own. Okay. It's for the civil service annuities paid to a husband or wife to the beneficiary or their children. It looks just like this one. I mean, if I go back here to this, it looks just the same as this. Okay. But it just is for civil service annuity payouts, and it always has a distribution code of number 4. All right. There's no difference to it. Now, the form, the RRB 1099, is in the railroad ones. So the employees contribute in 2 tiers. Tier 1 is Social Security benefits, just like a Social Security benefits. And Tier 2 is a distribution from a qualified retirement plan. All right. And how it looks is this. And honestly, I have not seen too many of these. I've seen maybe like 10 of these total. All right. I don't know how many of you guys have ever seen one of these things, but honestly, I've seen like 10 of these total for a railroad annuity. What's that?
I've only seen about 1.
Yeah, it tells you. I've only seen like 10 of these total.
I've seen several.
So,
color coded.
Yeah, they're color coded. It was actually really cool because especially by the, I guess they have them because the railroad.
Well, they're all on
centers.
The RRB 1099 and the 1099. They're all on one sheet, and we had twice now. We've had preparers in our offices that thought it was all one sheet and didn't put in both forms and just put in one, and it kind of.
Oh, that would throw them way off.
Yep, they ended up getting letters, and I had to put out fires.
Oh, that's good. Okay.
A blast.
So,
yes, there's 2 forms on that one form. Put them both in.
yeah, there's actually, I was going to say there's more than one. So,
But they're all attached, which makes it.
yeah, they think that it's just one thing. So,
yeah, it makes it confusing to new tax preparers.
okay. So, in this case, as you can see, she received this is Sandra Walden. She retired from the railroad. She receives a form 1099 R from the railroad reporting that her pension, that it is treated like a regular retirement plan. See the total gross paid, 19,000, federal tax withheld, 2,100. This is pretty simple. So the amount of in the form 1099R box 7, right here, here's box 7, is the total of box 4, 5, and 6. I mean, that's pretty simple. The amount in box 3 means that the former employee has a basis in the plan. All right. This is the employee contributions up here in box 3. And as you can see, there's no contribution here. But that is how much they have contributed, and it would have their basis in there. And that would be, so it would show the actual taxable amount would be the difference between the two. So use the inbox amount in the amount in box 3. I can't even talk now. The amount in box 3 to calculate how much of box 7 is taxable. In other words, it's really simple. Box 7 minus box 3 is going to give you the taxable amount, correct?
Yes.
So gross payments, total gross paid, 19,401 minus whatever would have been their contribution. Okay, so let's do a quick review. Now, as you can tell, pensions and annuities really are not that hard, guys. Let's be honest. Okay, they're just a payout. They're just a retirement plan. Kevin Valentine's Form 1099-R, is his distribution fully taxable, partially taxable, or not taxable at all? So this is his gross distribution, 5,487. Now, it doesn't say anything for the taxable amount, right?
Right.
But it is a G. Thanks, you caught that. So, what is a G?
Rollover.
Rollover. So, it is not taxable at all. All right. Did that actually show beforehand?
What?
It is not taxable at all. Okay. So, let's match the payment to the appropriate form by drawing a line from payments to the column in the form. All right, let's see if that works. The 401k plan payments, what do they normally get reported on?
1099R.
1099R. Awesome. Okay, so civil service annuity payments.
CSA.
CSA. All right, civil service survivor payments.
CSF.
CSF. Railroad. RR.
RRB, 1099R.
You got it. Awesome. Okay. Which of the following requires an entry on the 1040 on both lines 4A and 4B? So, distribution from an IRA. Okay. We know that the IRA is only reported on line 4A. So, the only IRA that's actually reported on any other form is the Roth, which gets that gets stuck on an 8606, right?
Right.
So can't be the distributions from an IRA. So, fully taxable disability benefits.
Nope.
Nope.
Nope. So, partially taxable pension plan distributions.
Yep.
That sounds like a possibility to me because you've got part taxable and part not, right?
Mm-hmm.
Because what are lines 4A and 4B?
Taxable and non-taxable.
And non-taxable. So that's taxable and non-taxable. So it sounds like partially taxable pension plan distributions.
Say that 3 times fast.
I don't think so. Partially taxable pension plan distribution. That, yeah, exactly. That's not a possibility. All right. So when a pension plan distribution is partially taxable, the gross distribution is reported on the 1040 line 16A, and the taxable amount is reported on 16B. Okay. For this, the partially taxable amounts are on 4A and 4B. When they're fully taxable, they're on 16A and 16B. All right, which of the following requires an entry on line 1? Okay, direct rollers between IRAs. Probably not. Because we don't ever report a direct rollover a traditional IRA, do we? Because it's not taxable. Okay, because what's line 40, what's 1040 line 1?
Wages.
Wages.
Another income that's taxable.
There you go. So taxable disability benefits that the taxpayer is under the minimum required minimum retirement age.
Yep.
That sounds pretty much like it. Taxable benefits because they're under the minimum retirement age. So I'm guessing it's the second one. So partially taxable pension plan distributions and fully taxable pension plan distributions. Those are pension plan ones. So probably not. So taxable disability benefits. So let's see. It looked like that is correct.
Yep.
Which is generally not. Now this is a not. So what do we want to do? Take out the not and see what it says if we had to. So which is generally not a fully taxable payment. So it sounds like which is a fully taxable payment. So pension payments from a qualified plan to which the taxpayer made no contributions. Well, if he made no contributions,
it's taxable.
It's taxable. So that sounds like it's fully taxable. So we don't probably want to count that one. Payments from an annuity purchased with the taxpayer's after-tax dollars. Well, that sounds an awful lot like a tax-exempt thing, doesn't it? Paid for with a tax-exempt dollar. So let's go back down to the next one. Remember, read them all, no matter what. Pension payments from a qualified plan in which the contributions were made with tax-deferred compensation.
Taxable.
Well, it's taxable. Okay, so disability payments from a qualified plan in which the contributions were made with tax-deferred compensation. It's tax-deferred compensation. So you're getting money out, right?
Taxable.
Taxable. So both of those sound taxable. So it sounds like an awful lot like that one. So let's see. Look at that.
Yeah. Oh, we're so smart.
Uh-huh. Zed received a $10,000 early distribution from his pension plan, and 20% was withheld for federal income tax. He received a check for $8,000. How much must Zed roll over to a qualified plan within 60 days in order for the full amount to be non-taxable? Now think about it. How much does he have to move over?
8,000? No.
How much was taken out?
2,000.
Nope. How much was taken out of his distribution?
2,000.
No. How much was taken out? Did he take out as a distribution?
Oh, 10,000.
10,000. So how much needs to go into the other account?
10,000.
Think about it that way. Don't think about anything else. How much do you take out?
10,000. So 10,000 needs to go.
Let's take a look. $10,000.
Yeah.
Because think about it this way. Don't read all the other stuff into it before you know the answer. What makes sense? Don't think about all the other questions.
Right.
It's saying Zed received a $10,000 distribution from his pension plan. Ignore anything else. You know that $10,000 came out. So it's saying, how much must you roll over to be a qualified plan within 60 days to be fully non-taxable? $10,000 came out. No matter what happened to it, $10,000 got to go back in, right?
Yep.
So no matter if they withheld 20% and he has a check, how much does he have to put back into it in that amount of time? He got to put 10,000 back in, right?
On Jackson Hewitt Tax Service.
So he'll get back in the end. Think about it on his tax return. What's he going to get back?
The 2,000.
He'll get back the $2,000, right?
Mm-hmm.
And he's got to put the $8,000 in, plus he's got to come up with $2,000 to make up for that. But he gets it back from his taxes then, right?
Right.
Because they withheld it. I mean, you don't have, it doesn't matter where the money went. Think about this. How much was taken out? How much has got to go back in? 10,000 came out for it to be fully non-taxable. 10,000 has got to go back in.
Yep.
So it's $10,000. So for a traditional IRA and other qualified plans, taxpayers must begin receiving a minimum distribution by when of the following year after they reach 70 and a half.
April 1st.
April 1st. That one's just you got to remember that one.
Yeah.
It's the weird one. You got to do it by April 1st of the following year. Okay, and it's not April 15th. That one's the one that's confusing because they put April 15th there too, and you're going, was it April 15th or was it April 1st? It's April 1st. And from then on, when does it have to be?
By December 31st.
December 31st. There you go. All right. Now Social Security benefits. Now this is the one that you get in trouble with only because everybody on Social Security benefits assumes that it is their right to get and they assume that it is tax-free. Okay. Number one, it is a benefit. It is not a right. Number two, it is not tax-free. It is if you make enough money, it will get taxed. Okay? It's one of those things that everybody hates, but it is true. So, step one, calculate total income. All right? This is to determine if it is taxable. Number one, take 1/2 of the Social Security income. Add all other taxable income plus any tax-exempt interest. That is your total income. Now what you do is compare it to the amounts here. If you are married filing jointly, the base amount is $32,000. If you are married filing separately, it does not matter. It's considered taxable in that sense. All others are $25,000. Now, I got to admit, I hate this chart, but I should revise this chart. This is a chart that James came up with, and I just don't like the chart itself. But so, if the total income is equal to or less than the base amount, it is not taxable. So if the total income is equal to or less than the base amount, which is $32,000 for married filing jointly, or $25,000 for all others except for married filing separately, which is just automatically, okay, it's not taxable. If the amount is more than the base amount, it's partly taxable. If it is partly taxable, okay, so if you're married filing separately, it is partly taxable no matter what, by the way. Okay. So if partly taxable, if between the base amount and the additional amount up to 50% is taxable. So this additional amount here, so if it falls somewhere between 32 and 44, it is partially taxable. If it is between 25 and 34, it is partially taxable up to 50%. If it is above this additional amount, the 44 or 34, it is up to 85% taxable.
Yep.
Now, I know people do not like that. I know that. You know that. We have a whole lot of people who really hate this because they think that it's my Social Security benefits. I've been paying into it for years. Why do I not get it back? Well, the problem is this. Like I said, the important word in this whole discussion is benefit. Okay? It is not your Social Security right. Okay? So, what happens is to calculate it. You take 1/2 of the Social Security income, you add all other taxable income, plus the tax-exempt interest, which is from the 1040 line 2A, and that equals your total income. When you compare it, then you have to figure out where you fall into. All right? So, once you start looking at this, you will be able to understand where you fall under the taxable levels. Now, unfortunately, especially now, this is going to become an issue. Do you know why this is going to be an issue?
Why?
Because my generation just started hitting retirement age. And we're the baby boom, a lot of the baby boomers. And as a result, we're going to get awfully upset when we start finding out that it's not a right. Okay? Because most of them assume it is. So it's one of the things we're going to have to start dealing with. That's why do you think all those assisted living centers just went up everywhere?
What the
Okay.
baby boomers.
Uh-huh. All those assisted living centers started going up because they're hitting the age where they're all getting to retirement. All right? And they're all starting to be, it's basically my parents' generation. And they're all getting to where they're getting Social Security benefits, and they have for a couple of years, or they're just about to, that sort of thing. And they are not going to be happy. Okay? And there's a whole lot of them. So those are the guidelines. Again, like I said, most of us assume it's their Social Security right. I paid into it for all these years. Why am I not getting it? It's because you make too much money. Okay? And if you look, $32,000 does not seem like a whole lot of money, does it? And for it to be hit that additional amount, that $44,000 isn't a whole lot to fall into that 50% taxable. So they're not going to be happy because you have to get below that $32,000 to be non-taxable. Beth, have you been up against this, I assume?
Up against what?
Up against the people who are upset about their Social Security benefits not being a right?
Oh, yeah. Well, I don't specifically hear a right, but I specifically hear them talk about why is it taxable? Why, all that.
I've been paying into it for all these years. Why am I not?
Yep.
Yeah.
Yep.
It's because you were paying into it for people. Social Security wasn't meant to be your retirement plan.
Yeah.
Social Security is part of welfare.
And I'd just like to say, well, by the time I retire, probably 100% of it will be taxable. So you feel lucky.
Uh-huh. Yeah, exactly. There you go.
Yeah.
Feel glad, because.
Did you just say Social Security is welfare?
Yes, Social Security benefits are actually a welfare benefit. Most people don't realize that.
It's not welfare in the sense that people typically think of welfare as for.
No, I know. They don't think about it as, but yes,
it's not
Social Security.
For poor people.
It's not for poor people. It's meant for the elderly who cannot afford to pay for themselves. That is actually what Social Security was designed for.
Yeah, it was set up because people weren't saving.
Yeah, they weren't saving, so
Didn't
they
have a
were not,
retirement.
they did not have a retirement in place. And so as a result, they were not able to support themselves, just like a welfare recipient. That's why it was considered a welfare project.
Yeah.
That's
People
where it
get
falls
weirded out
under.
when they say earned income credit is welfare.
Yes, that's interesting, isn't it?
Mm-hmm.
But yes, Social Security falls under the Department of Welfare. Social Security falls under the Department of Health and Family Services. Okay, so it is not, and that's why, like I said, the most important word up there, if you look at the title of this, is Social Security benefits. Okay, and most people do not understand that. Here's the problem. I know that a lot of people hate that. But yes, what happens is when you're discussing it with people, you have to be really tactful about it, but it is not a right of people and it's not your retirement program. So unfortunately, when you actually did do your retirement correctly and you do have additional income, it is not meant to be your retirement. So,
Well, I'll tell you what, I'm not going to tell anybody that's that age that this is considered welfare because they would be highly offended.
well, I realize that, but it is the truth.
So
It is a
I'll
welfare
find another word.
Just like
It
I
is-
don't tell people earned income credit is a welfare.
Yes,
Yeah.
but it is a welfare program, unfortunately. To
Yeah.
us, we have to understand the truth of it.
Yeah.
It is,
Yeah, I
that is a
thought it was
welfare program.
designed for lower income people.
Yeah. There's a stigma with that word that.
Mm-hmm.
Yes.
Yes. See, the problem is we have associated certain words with certain things, and unfortunately, that's what this benefit is a support plan for people who are not able to support themselves in retirement. And people don't like hearing that it is not something that they were paying into as their retirement plan.
And even if they can support themselves, they could still get Social Security.
Yes, yes, but it is going to be taxable. And unfortunately, if your income is high enough, you necessarily can't get Social Security.
Right. Yeah. If you're still getting income. Yeah.
Yeah. So depending on if your income is high enough, you're not eligible for Social Security. So.
When does that happen? How high?
I don't remember what the cutoff is, but I think if you're making over $75,000 a year in earned income, I think it's 75. I can't remember what the cutoff is.
Earned income, like you're still working, right?
Yeah.
Not like if you're getting other pensions and annuities and.
Right. But the thing is a lot of people realize that what Social Security is, their payments on Social Security are not that high. So when they have a Social Security benefit coming in, it turns out it's not that high, and they'd be better off working. So as a result, they're working instead, and if they're making enough, it eliminates their Social Security benefits entirely. So, but
Unless you're over a certain age, then you can
yeah,
work as much as you want and still get it.
yes, if you're over, I think it's 70, you
Yeah.
can do it. So, but there's only, like I said, there is a point where this actually phases out if you're making too much money. So that is one thing to realize. That's why, like I said, it is a benefit and not just a right, and that upsets a lot of people. So because they've used it as a retirement plan. So like I said, here's the problem: is when I actually get to retirement age, if I'm making too much money, I can guarantee you that I'm going to be in trouble. That there's no chance I'd be able to get it. So, all right. Now, the Social Security benefit statement is pretty straight up. It says what the amount of the benefits that you were paid are, and realize something, they're not that high. Okay. So benefits were paid benefits repaid in Social Security in 2017, the net benefits for 2017, which is basically box 3, which is your benefits paid, minus the benefits repaid to Social Security, equals the taxable amount, basically. This is the amount that is considered possible for tax. I should word it that way. Okay, box 5 is the amount that is possibly able to be taxed, depending on what your other income is. Okay.
Mm-hmm.
So you must contribute at least 10 years to receive the benefits. So that's an important thing too. If you have not contributed for at least 10 years, guess what? You're not eligible for Social Security benefits. That upsets a lot of people too. Because a lot of people say, well, I've been a housewife all these years. Guess what? Unfortunately, that does not count.
But wasn't there a period of time that you could take part in your husband's?
You can if you are married and had your husband's income, as long as you were married for X number of years, and I can't remember, I think it's for 15 years, then you are considered married to your husband and eligible for his Social Security benefit.
Well, I know a few people who are drawing Social Security and they were housewives. Glad I went back into the workforce.
There you go. So that's one thing to consider too, is a lot of people who were stay-at-home moms. I mean, frankly, I got news for you. I know stay-at-home moms who work harder than some of the dads who go to work. So don't think I don't know, realize that stay-at-home moms work their butts off.
It's a tough job raising the next generation of folks.
Yeah, it is. There's a lot of hours involved in it. You know, hey, I've been a foster parent for years. I was a foster parent. I understand how much that takes.
I might be raising somebody's next doctor or, next judge or something. It's a very big job, and this country, I don't think, does a very good job of supporting children.
No, it doesn't. So, but as a result, unfortunately, if you were not married to somebody who was a wage earner during, a large portion of that, it can hurt you down the road.
Yeah.
Yep, you can be in trouble.
And a lot of people don't know that you can go onto the Social Security website and look at your benefits and look to see what you're making. Yes. I was explaining that to my nephew the other day, who had no idea he could even look to see what he was going to be drawing.
And by the way, that is one of those pieces of advice that you should be giving to your clients, because that is some of your taxable advice.
Yeah, I've brought it up.
They're able to plan this out.
Yeah, because they don't send the papers anymore in the mail. It's all electronic.
No, everything is electronic.
Yeah. All you have to do is create
the username and password and verify your account, and yes, you can get it.
I get a paper in the mail.
Do you? Oh, yep. They stopped sending it. I have to go look.
Yeah, I think I actually elected for the electronic one only, is what it is.
Yeah.
Because I get mine electronically. But yeah, you want to. Oh, good! You're gonna get a call here in a second.
Great. I'll run to the other computer.
Because I missed this call, I just ignored it. I'll let you go.
What?
I'll let you go to it. So it should be ringing here in a minute. So, anyways, Social Security benefits are one of those topics that if you wanted to discuss tax benefits with your customers, that's a really important one to discuss with them. Bring it up to them. Tell them how they can get onto the site and how they can start to review it. I think I just heard her phone ring. Gee, I must be psychic or something. I can predict when her phone's going to ring. I can predict the ringing of her phone. So remember that. It's very important that we give advice to our clients as well. This would be a good piece of advice. When they come up with Social Security benefits, okay, determining what is taxable and what is not taxable is sometimes really difficult, okay? With that, they have the Social Security worksheet, okay?
Yeah.
Let's give her a second. I think she's on the phone here.
Okay. There's also a worksheet on the statement when you
To this.
No bueno.
All right. So when you have people who have Social Security benefits, you want to run it through normally if there's going to be, if they follow this rule, and if they follow, go back to here, follow
Mhm.
this rule, and if they fall into this either 50% taxable or 85% taxable, you want to use the calculation sheet, the worksheet, to determine how much is going to be their actual taxable amount. So what you want to do is go through the worksheet, and it's going to give you the amount that is considered a taxable Social Security benefits. All right. And understand something, again, when I say taxable, Social Security benefits are still barely taxed, okay? They know they're a retirement. All right, so if you're receiving a Social Security benefit, they are taxed at a lower or a very small amount. So they have a special form to determine how much is taxable. All right, and so it's not a large amount that is considered taxable. All right, so it is not like when I said, you are responsible for taxes on it. Consider something that it is not taxable at a very large rate. So when determining if someone must file a tax return, you must consider their taxable Social Security income. All right, so that is one of the things that is always a question. You get a retiree and they say, well, I don't have to file my taxes. I only had my pension and my Social Security benefits. So I shouldn't have to file a tax return, right? Is that always necessarily true?
Nope.
Nope. Because what ends up happening, if it turns out that person has actual pension benefits that are pretty substantial, plus Social Security benefits that may be pretty substantial, guess what? It may be a taxable amount. Okay. So when you're considering that, you must determine first what is their taxable Social Security amount, and if they are not only required to file, but how much they may have to pay in taxes on it. All right, so let's run through an example. Turner and Brianna, Turner is 62, Brianna 64, were married and lived together all year. They're married filing jointly. They have joint dividends of $90. Turner's wages are $8,121. Brianna's taxable pension is $11,004. Brianna's Social Security benefits, because Brianna's 64, $15,256. So she's actually doing pretty good there. We're talking what, $26,000 there. So Brianna, her Social Security benefits are not included in her gross income. Why is that? Let's go back to the chart. How high is this number? Let's go to this number. How high does the number have to be for it to be considered taxable? 32,000.
Mm-hmm.
They're married filing jointly. Okay, so remember that one. So it's below the amount. So the only thing is these two amounts. So we've got $19,125, right? So their combined income is less than the gross income amount for their filing status, because they're married filing jointly. And what is the amount you have to hit?
32,000.
Okay, but what about are they required to file?
The
Required
additional. Oh.
required to file for married filing jointly?
Yep.
How much is that amount?
24,000.
There you go. So their combined income, even with the dividend, okay, because the joint dividend's another $90, so they made $20,700. Okay, they're not there yet. They don't have enough, so they are not required to file.
Nope.
Okay, now reporting Social Security benefits for taxpayers required to file a tax return. Social Security benefits on Form 10 on the SSA 1099 must be reported on the 1040A on the 1040 on line 5A. Okay, so you enter that on the form box 5. You enter the total form SSA 1099 box 5A amounts on line 5A. That's the easy way to remember it. Okay, box 5, line 5A. Okay, and you enter the taxable amount on line 5B. Okay, so there's a reported amount that's on box 5A and the taxable amount on line 5B of the 1040.
We are spoiled.
Because we have Profiler doing it for us.
Yep.
So, Kevin is single. The only income he received was Social Security benefits. Yay! Which statement is generally true? His benefits are not taxable. Well, I don't know. That's probably not necessarily. Maybe, maybe not. His benefits may be taxable if they are high enough. Well, I don't know. Maybe, maybe not. He must file a tax return. Probably not that. Now, see, the point is here, which statement is generally true? That one's a harder one.
Yeah, it is.
85% of his benefits are taxable. Well, that one's not true. You don't have a dollar amount there. Okay. So
Maybe taxable.
maybe taxable if they're higher enough, but not necessarily. He's single. Do you really think his benefits are going to make it over the limit? So his benefits are not taxable is probably it. His only income he received were Social Security benefits. At the most he received basically $1,000 a month.
It's not taxable. That's right.
Yep.
If that's all you receive, it's not taxable.
It's not taxable. There you go. You caught that. His only income was that.
Yeah.
All right. Review Javier's 1099. Javier was born in 1955. His Social Security number is 400-1484. He's single. His income, not including the Social Security benefits, he has a taxable pension of $18,600, wages from a part-time job of $9,400, taxable interest income of $990. So he made $28,990. Okay, so let's fill out his Social Security benefits worksheet. All right, so let's take a look here. So what amount is Javier's total Social Security income that must be reported on line 5A? So let's see here.
It is.
So we know here, let's see, it looks like
6,130.
there you go, 6,130. Okay, what amount is Javier's taxable Social Security income? Well, let's see.
Do this worksheet. Let me go back.
Got to work on that worksheet. Let's see here. I don't have a worksheet.
Let's go back to the beginning. I got this one.
There we go. So we've got right there. So we've got 6,130.
He has. Go forward.
And go forward again. Let's see.
To the first of the question.
That
right
one?
There, right. Oh, you went past it. There, right there.
That one?
Yep. He's got. Well, income is see if I did this right. 1860, 940. Oh, I didn't. Okay. It's in between.
So what'd you come up with, Pam? You got an idea?
I'm gonna, let's see, wait just a second. Up to half of it could be taxable.
There you go. So
65, yeah.
3,065.
Right.
Okay, so let's go through this. So $3,065. Look at that.
Yep.
All right, so that is what we get for it. $3,065. So, all right, Pam, that was awesome.
I used this little chart thingy.
There you go. So,
I can't see that chart
okay.
very
All right.
well with my laptop, so.
I understand.
Okay.
All right, so let's get into this one. Now, this one's a little bit different because it's always a pain in the butt because everybody thinks it's supposed to be tax-free.
How can they think that?
You would be amazed how many people think that unemployment is supposed to be tax-free.
Well, I know they do, but they're, gee.
I got unemployment. Well, why are you taxing me on unemployment? That doesn't make any sense. I was unemployed. Now I got to pay taxes on it? And the worst part is, by the way, they don't withhold taxes. So, seeing they're going to do that, they might as well withhold taxes. It would probably make it better for them.
Yes, I tell them to.
Yep. Well, if you tell them to, but do you honestly think anybody on unemployment, which is less than your normal paycheck, they're going to actually say, oh, by the way, hold out taxes? They want to get the most they possibly can. They're trying to survive.
I know, but I still tell them when I
know.
see it, and I say, you didn't have them you didn't ask them to withhold it, and they said no.
Why would I do that?
And I say, well,
you
might be owing some tax.
Yep. So unemployment compensation, any amount, which is key, a taxpayer receives under an unemployment compensation law of a state or federal government is reported on a 1099-G. All unemployment is reported on Schedule 1 of the 1040, line 19.
Yep.
Okay. So, let's take a look. This is what you get. 1099-G. Unemployment compensation, federal income tax withheld. Honestly, like I said, nobody ever tells them withhold it. They always just leave as is. That is probably the worst thing you can possibly do. So it goes under unemployment compensation. When this happens, federal income withheld from forms W-2 and 1099-G. Okay? Pretty simple on where it goes. But John received $3,700 of unemployment compensation this tax year. How much would be included as income on his tax return?
$3,700.
$3,700. Pretty simple.
Yep.
But everybody thinks it's supposed to be zero.
What? Why? Where did that rumor get started?
Everybody does. Everybody you talk to, as soon as they get unemployment, they go,
Yeah.
why am I being taxed on unemployment? I mean, I was unemployed. Come on. If you've ever done a tax return with anybody with unemployment, that's their first question. Why am I being taxed on unemployment? That's insane. I wasn't working. Because it was income. You know, you were getting paid for it. And they're like, no, I wasn't working. Yeah, but instead people were giving you money, you know?
Or they don't want to include it in their refund advance.
There you go.
Later, and then find out that they really don't, get.
Yeah, they're not getting any money back. They're actually owing money because they want to make sure that that unemployment thing doesn't show up yet. You know, my refund advance. Oh, did I forget that one? I forgot my unemployment. I didn't get it yet. I totally forgot. I'm sorry.
My coworker Cindy had somebody come in with one W-2 and then came back with 4.
4 unemployment ones. I've done
not unemployment.
4 W-2s.
4 W-2s.
Yeah, actually.
Forgot about 3 other jobs.
Yeah. Well, that's what's really funny is we have the ones that'll go, well, here's my W-2. Do you have any others? Well, no. I was. Oh, and it comes back with a stack. I mean, literally a stack of them, and go. Well, they were. I didn't even think about these.
Yeah. Well, they didn't come in the mailbox. I didn't get them.
I didn't get them yet, so I didn't even
claim it.
I didn't even think about it. This is your current one, right?
Especially 1099-Bs. If I say, did you have any stock sales this year? I see that you had that last year. Oh, well, it didn't come in the mail. And it's like, well, it's February, so we should probably wait.
Yeah. So we have a problem there. So let's take a look at this one. This is a 1099-G. How much is entered on Sam's Schedule 1, line 19? 19 is the federal tax withheld. So no, it's not. It's not line 19. That's the line 19 is how much was paid. So
how much was paid?
How much was paid? Unemployment compensation. So what do you think? Line 19, because the paid goes on the lower section. So what do you think?
What's on line 19?
Yeah,
unemployment paid. Unemployment compensation.
Oh,
5642.
5642. That is absolutely correct. Now, what amount is entered on the 1040? Oh, this should actually say the withheld amount.
282.
282. That is the withheld amount. Got to fix that one because they actually both say the same. No, line 16. That is correct. Line 19. Okay, so that is correct. Line 19 is the paid amount. Line 16 is the withheld amount. So that is correct. Line 16 is the withheld amount. So 282.
Full beans.
And that is all you need to know about unemployment. It is a royal pain in the butt because leads us to more amendments than you could possibly imagine. Because everybody brings it in late. Okay, it's it's terrible. They come in, was I supposed to do that? Why? I'm like, really? Honestly, you're going to go there? You have 14 of these things. You forgot how many jobs and the other? Yes, we did. Oh, good. Glad to hear it. So, unfortunately, this happens all the time. but it is a reality we have to deal with. Okay? So no matter what, remember that when you are dealing with these people, they are going to have these W-2s, these 1099-Gs that will show up at the last minute. Okay? So, wow, is it already? Guys, it's a Friday. It's 4 o'clock already. Let's call it a day.
Okay. I'm good with that.
Because I think Beth looks like she's like, I'm hungry.
I'm okay sitting here listening to you.